The street may be fundamentally underestimating a massive structural shift behind SK Hynix's surprising 11% surge. This isn't just a daily swing, it's a critical signal. Institutional capital is quietly repositioning, anticipating a profound re-rating in a sector essential for the AI revolution. What exactly is changing? SK Hynix, a South Korean semiconductor giant, sits at the heart of the global memory market. Its core moat is built on highly specialized DRAM and NAND flash memory production. But that is only part of the story. The real strategic value emerges in its leadership in high-bandwidth memory, or HBM, the advanced chip technology powering today's most demanding AI processors. The value proposition here is critical. Traditional memory can't keep pace with AI accelerators like NVIDIA's A100 or H100 GPUs. HBM is stacked vertically, offering vastly superior bandwidth and lower power consumption. This makes companies like SK Hynix, alongside competitors like Samsung and Micron, indispensable partners in the AI infrastructure build-out. They're not just selling chips, they're enabling the next generation of computing. While we don't have fresh quarterly specifics for SK Hynix today, the 11% jump reflects a broader market anticipation. After a deep cyclical downturn in 2022 to 2023, the memory market is showing clear signs of stabilization and recovery. Inventory levels across the supply chain are normalizing, and enterprise demand, especially for AI servers, is accelerating. The market appears to be pricing in a significant margin expansion story for HBM, and a broader demand recovery for standard memory. Here's where the margin metrics become interesting. HBM chips command significantly higher average selling prices and better margins than standard DRAM. SK Hynix, as an early mover and technology leader in HBM3 and HBM3E, is directly benefiting from this premium pricing. This means a shift in product mix towards HBM can dramatically improve overall profitability, even if total gigabyte shipments don't see massive increases immediately. That's a powerful lever for earnings visibility. The next signal comes from management's capital allocation. While we await specific commentary, industry trends suggest a clear focus. Memory manufacturers are now prioritizing CapEx on advanced nodes and HBM capacity expansion, rather than broad-based production increases. This disciplined approach prevents oversupply, which was a major culprit in past downturns. SK Hynix is strategically investing to maintain its HBM leadership and capture share in the most profitable segments. Looking forward, corporate guidance from memory firms is likely to reflect a cautious optimism. Expect projections for HBM demand to remain robust, potentially outpacing supply in the near term. This structural deficit drives pricing power. For standard DRAM and NAND, we anticipate a more gradual recovery, with strong tailwinds from new consumer devices and enterprise upgrades. The key takeaway: management teams are signaling a more sustainable growth trajectory, less prone to the boom-bust cycles of the past. Now look at how the broader sector is reacting. SK Hynix's rally tracks a rebound in US semiconductor shares, following an earlier sell-off. This broader strength underscores a positive shift in the macro environment. Global GDP growth, while moderate, is stable. More importantly, the secular trend of digitalization and AI adoption remains firmly intact, providing a powerful policy tailwind for the entire tech sector. This is not just a rebound, it's a re-acceleration. The competitive landscape in memory is intense, dominated by three key players: Samsung, SK Hynix, and Micron. While Samsung remains the largest overall memory producer, SK Hynix has carved out a leadership position in the high-growth HBM segment, particularly in high-volume supply to AI GPU leaders like NVIDIA. This strategic niche insulates them from some of the broader DRAM cyclicality. Meanwhile, foundry giants like TSMC are also critical, as they fabricate the logic chips that pair with HBM. However, even with strong tailwinds, structural risks persist. The semiconductor industry remains inherently cyclical. Overbuilding of capacity, even for HBM, could eventually lead to oversupply. Geopolitical tensions, particularly regarding US-China tech policy, could disrupt supply chains or limit market access. Furthermore, A slower-than-expected enterprise uptake of AI or a pause in data center expansion could temper demand recovery. We are not out of the woods yet. Cost inflation also remains a vulnerability. The advanced manufacturing processes for HBM and next-gen DRAM require significant investment and specialized materials, which can increase production costs. Regulatory pressure, particularly on environmental impact and energy consumption, could also become a factor, given the power-intensive nature of semiconductor manufacturing. These factors, alongside competition from Intel entering the foundry space, add layers of complexity. That leads us to a bigger question regarding terminal risk and forward earnings visibility. For SK Hynix, the multi-year thesis hinges on sustained HBM demand and a broader memory market recovery. Early indicators suggest robust earnings visibility for HBM through 2025, driven by AI server ramp-ups. The re-rating of the stock appears to reflect this improved outlook, moving from a cyclical value play to a structural growth story tied directly to the AI infrastructure build-out. This sustained demand for HBM justifies a valuation reassessment for memory players. Traditional cyclical valuation metrics might undervalue companies like SK Hynix that have successfully pivoted to high-growth, high-margin segments. As the market fully prices in the AI narrative, we could see a multiple expansion, bringing their valuations more in line with other critical AI enablers. The capital rotation into these foundational tech plays is a powerful signal. So, where does this leave us tactically? SK Hynix, given its HBM leadership and the broader memory cycle turnaround, warrants a breakout watch designation. The stock is demonstrating significant positive volatility expansion, backed by volume, consolidating above key resistance levels. This indicates building structural momentum. Other memory players like Samsung and Micron also deserve close monitoring as the entire sector reprices for the AI era. This isn't just a trade, it's a structural shift. The implications extend beyond just SK Hynix. This rally is a powerful read-through for the entire AI supply chain, from NVIDIA's GPUs to TSMC's fabs. Understanding these structural shifts is crucial for protecting and growing your capital. We'll continue to track these developments and provide deep institutional analysis here at SR Money News. Make sure you're subscribed and have notifications turned on so you don't miss our next deep dive into the markets. Thank you for watching.